Hey traders, Mike Sir here. Welcome back to part 2 of the 4-part video series where I teach you how to trade futures contracts. In part 1, I taught you how to trade the US stock market utilizing S&P 500 futures contracts and their contract specifications. Also, I talked about trading strategy that can help you capture big trends in the markets. Now, if you haven't watched part 1 yet, please watch that video as it will give you a good overall understanding of how futures contracts work. So in part 2, I'm going to teach you how to trade the precious metals market, specifically the gold market, utilizing futures contracts. Now, in times of stock market crash and turmoil around the world, gold can be an attractive asset class to trade. So let me explain. Gold is a precious metal that is often associated with jewelry, and before paper currency was introduced, gold coins and gold bars were a form of currency that were used for an exchange of goods and services. Nowadays, gold is seen in investors' mind as a global store of value against declining values of paper money. Now, from a fundamental perspective, gold is generally viewed as a favorable hedge against inflation, particularly in 1980 when inflation rates hit almost 15%. Now, here you can see that gold prices skyrocketed from less than $100 per ounce in 1976 to almost $900 per ounce in early 1980. With current inflation rates hitting over 7%, which we haven't seen since 1982, gold is now becoming an attractive asset class to own. And please stay till the end of the video where I'll share with you the strategy for trading gold. Besides gold being an inflation hedge, what other factors causes gold prices to move up or down? Well, to explain this question, we must discuss the typical inverse relationship that the US dollar and gold have, meaning that they typically move in the opposite directions of each other. So now let's analyze a few catalysts that causes the US dollar to rise in value and thus push gold prices lower. Now the first example is rising interest rates. Now typically when interest rates rise, investors like to park their money in US treasuries, which are priced in US dollars. Therefore, this will increase the demand for US dollars and push up the price of the US dollar. Gold, which doesn't offer a yield, is not as attractive of an asset class and therefore declines in value. Another example is gold is priced in US dollars. So when the US dollar rises in value, then gold is worth less per US dollar and it takes less US dollars to buy gold and thus push gold prices lower. Another key factor is a strong and growing US economy, which signals optimism and could result in a strong US dollar. Now, gold, deemed to be a safe haven asset in times of crisis, ends up declining in value in a strong stock market environment. Lastly, in 2008 and 2020, when the stock market went into freefall and governments around the world had to print trillions of dollars to stave off economic catastrophe, this huge money supply suddenly led to a huge surge in gold prices. Before I discuss the way to trade gold with futures contracts, I want to let you know this video is sponsored by Iron Bean app. Now, if you're looking for a trading platform to trade futures, you should consider utilizing the Iron Bean app. It's a cloud-based platform that allows you to access trading strategies, over 300 plus built-in indicators, quotes, charts, detailed market information, and more importantly, give you the same user experience whether trading on your desktop or on your phone. Now, most traditional brokers have a separate website, desktop program, and mobile app that gives you varying degrees of information. With the Iron Bean app, all the information you need to trade futures is always at your fingertips. Also, since the app is running from the cloud, you're able to place trades, write formulas, pull up chart data, and execute strategies right at the exchange data centers, resulting in fast trade executions. Please click on the link in the description box below to download the free app now and start trading today. Okay, back to the video. Gold futures are very popular contracts for many precious metal traders and typically trades the equivalent of nearly 27 million ounces on a daily basis. Now, like the S&P 500 futures, they are also a derivative contract traded on the Chicago Mercantile Exchange's Globex electronic trading platform and remain closely tied to the spot gold market. The way to trade them is through buying and selling the full-size contracts under the ticker symbol GC. Now, each contract size of a gold contract represents 100 ounces of gold. So if gold is currently trading at $1,800 per ounce, the value of one contract is worth 1,800 times 100, which is equivalent to $180,000. If you're day trading, you only need a margin of $500 in your account, while if you're holding the contract overnight, you need a margin of $6,600. However, if the margins are too high for you, you can opt to trade a mini gold contract, which is half the size of a full-size contract and represents 50 ounces of gold per contract. With a mini contract, you only need a day trading margin of $250 in your account and $3,300 overnight margin. Lastly, if the margins are too high, then you can opt to trade a micro gold contract, which is 1/10 the size of a full-size gold contract and represents 10 ounces of gold per contract. With a micro contract, you only need a day trading margin of $50 in your account and $660 overnight margin. As well, the full-size contracts are traded in 0.10 increments, which means that each 10 cents change in the gold contract has a monetary value of $10. Now, the mini-size contracts are traded in 0.25 increments, which means that each 25 cents change has a monetary value of $12.50. The micro-size contracts are traded in 0.10 increments, so each 10 cents change has a monetary value of $1. Lastly, the contracts expire every other month, starting at the end of February, April, June, August, October, and December. Before I share with you the trading strategy to trade gold, please take a moment to like this video, hit that subscribe button if you haven't already, and tap on the notification bell. You'll be alerted when the next video comes out for this 4-part video series on how to trade futures contracts. Now, the trading strategy that I like to use to trade gold is called relative strength trading. Now, as I discussed earlier, gold has an inverse relationship to the US dollar. Now, I want to look for an opportunity to buy gold when the US dollar is falling and an opportunity to short gold when the US dollar is rising. So here's a chart of gold on the left-hand side right here and a chart of the US dollar on the right-hand side. So what I've done here is I drew some trend lines extending it from here all the way here. You can see it's on the downtrend right now. And then I drew a horizontal resistance level right here. And also here on the US dollar side, I basically drew a trend line up. So you can see the inverse relationship, right? Gold is going down, US dollar is going up. So what we want to do is if we're looking to buy gold, essentially what we want to do is we want to see it break above this downward trend line here. So signaling that the downtrend is over. So when gold breaks above this downward trend line, we want to see US dollar break through this upward trend line, signaling the end of the uptrend. But what I'd like to see more is there's a support level right here. So ideally, I'd like to see US dollar go down, break this upward trend line, and also break this support line. So what I want to do in terms of entering gold here is once it breaks above here, we want to see the US dollar break through this and this. So that will give me greater confidence that this trend line break would be valid. So we're looking for a target probably above 1850. Now you can see here there is a resistance line here at around 1865. So ideally what I want to do is I want to buy gold once it breaks above 1850 and then add to my position above 1865. And when it does break through, again, I want to see the US dollar confirmation. So essentially this relative strength trading is you are trading an asset like gold and you base it all on the trend lines, based all on the support resistance levels, but look at the US dollar to give you confirmation that the inverse relationship is working. And if it is, then it gives you much greater confidence to buy gold. Thanks for watching part 2 of the 4-part video series of how to trade gold utilizing futures contracts. In part 3, which will be released next week, I'm going to show you how to trade crude oil futures contracts. So please make sure you hit the subscribe button and notification bell so you'll be alerted when the next video will be released. I'll see you all in the next video.